QuickBooks Pro Plus Desktop 2022 OneNote presentation, make amortization table. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introductions, 8020, make amortization table tab. Also take a look at the immersive reader tool, topic introductions in the text area too, same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're starting off with a screenshot of the home page. We're going to be taking a step away from the QuickBooks, looking at the construction of an amortization table in, say, a spreadsheet program like Excel, so we get an idea of what an amortization table is as it relates to a loan and how it might be used in order to record payments. Payments, when recorded using typically a write check type form. The reason it's a little bit more complicated is because there's going to be 3 accounts affected instead of the typically just 2, and some of those accounts will change with each payment. Therefore, it's going to be a little bit difficult to memorize the transaction. Here we're looking at the balance sheet. We're concentrating in on the loan payable, imagining then that we have an amortization table that we either have or need to create related to it to make the payments on it. If we then construct a amortization table, which is something that might be done by the loan itself, you might be given an amortization table, or you might construct it yourself if not given an amortization table, or you might ask your CPA firm possibly to construct an amortization table for you so that you can populate the loan payments properly. You can also try to do more of a cash basis system when you populate the loan information into your system and see if you could have the CPA firm then make adjusting entries to account for the interest and the short-term and long-term portion of the loan. So if this is going to be our information, 72,000, 5 years, the months then would be 5 times 12 or 60 months. The rate is going to be 5%. The rate will typically be a yearly rate, and the payment's going to be $1,358.73 about. So if we then were constructing a table, then the table would look something like this. We'd start with the loan principal amount over here. We've got the payment. The payment is always going to be the same all the way throughout the loan period, which you would think would make things easy, except for the fact that when you record the check, you typically will want to be recording the interest and the reduction in the loan principal, and those two things will differ. You can see for the first period, it's $300. I won't get into detail on actually building this, but we do it in the presentation. You can take a look at it there. But it starts off at $300. The loan reduction then is going to be the payment minus the interest amount, or $1,058.73. For the loan balance then goes down from $72,000 by that $1,058.73 to the $70,941.27. The payment for payment 2 is the same, but because the loan principal went down, what the interest, which you could think of as kind of like rent on the loan, also went down, is now only at the $295.59. And if I take the $1,358.73 minus the $295.59, that gives us $1,063.14. And if I take the $70,941.27 minus the $1,063.14, we get the $69,878.13. So you can see as we go through the loan, the interest amount actually decreases and the loan reduction increases as the payment then remains the same. So we're going to need this table then in order to record properly the transactions into our system, which we'll see in future presentations, but it'll basically look like this. We're going to write a check. Checking account would go down by the payment amount, and then the other side has to go to 2 accounts instead of 1. One account's going to be an expense account for the $300 for like the rent on it. Basically the interest is kind of like the rent of the purchasing power of the money. The other account being to the loan payable, which will be reducing the payable to $70,941.27. And then in the second payment, we'll have to say the cash or checking account will go down by the same amount, but the interest will then only be affected by the $295.59, and the loan reduction will go down by the loan will go down by the $1,063.14. So we'll see that and recording those transactions in a future presentation.